A surprisingly weak jobs number spooking the market. Payrolls dropping for the first time in 4 years. But will the Fed jump into action? Our market task force is on the money tonight. Michael Farr is managing director at Farr Miller in Washington. Jim Paulson is the chief investment strategist of Wells Capital Management. And Peter Schiff is president of Euro-Pacific Capital and author of Crash Proof, How to Profit from the Coming Economic Collapse. Michael, I mean, you're my permabull, but on a day like this, I don't know where are you still wearing your horns, or have you put them away?
The long-term horns are always on, Melissa. But, you know, as we said Wednesday, I think we're in for kind of a long road here. The data continue to come in to say, all right, look, this is going to be a period of tough sledding. I would quote my friend Vince Farrell, who this morning on CNBC said, just everybody stay calm. Really important in markets like this. Okay, we've got a tough market. Millionaires have been through tough markets like this before. We have great global growth, and there are good places to be. But with this jobs number that puts the Fed in a position to ease, Alan Greenspan says they can't do enough to really stop the problem. Long road to sled, but there's still good places to be. So I've got long-term horns still with me.
Jim, what do you think?
Well, I share the concerns. I've been bullish too, and it's certainly a shocking number to come up and see a decline in payrolls. But I really think that these payroll numbers have been really volatile and subject to big revisions. This one probably will be too, Melissa. I'm mostly
what do you think?
suspect
You think it's going to be revised to the positive side?
I do. I mean, like, for example, supposedly we lost 46,000 manufacturing jobs, 65,000 over the last 3 months, and yet almost every other measurement of manufacturing in the last 3 months has been positive. ISM manufacturing survey has been solidly above 50%. The employment portion of that survey has been above 50%. Unemployment claims have held in the low 300,000s. I'm a little suspect.
But Jim, the manufacturing job loss was really bad today, and the number today, and you add to that, we were down 4,000. We're going to add another 12,000 to that for next month's report at a countrywide today, right? I mean, this is bad.
Well,
that won't come in manufacturing jobs. I agree that there'll be more financial job losses. But what I'm saying is I see other positives. I see manufacturing recovering with a lot of numbers, and trade is improving. And I'm just wondering, I think what this report tells us is the economy's slowing a little bit, job growth slowing, but I'm not sure it's dying.
I want to get Peter in here because I see him shaking his head, and he is our Kodiak in the bear cave. Look, what do you think?
Well, first of all, there are a few good places to invest. Unfortunately, very few of them are here in the United States. You know, in your segment before, you talked about the return of prudent lending standards that we had 10 years ago. That's going to happen. And unfortunately, or fortunately, real estate prices are going to go back to where they were 10 years ago.
10 years, really?
Yeah, and so when all this phony home equity is wiped out, when all this phony home equity is wiped out, Americans are going to stop spending. And when all these mortgages are reset, whatever money they have, it's going to go to higher mortgage payments. We are going for a long overdue recession. It's going to be very severe. You know, somebody earlier on CNBC today said that, you know, these jobs numbers increased the probability of recession to 40%. It's 100%. It was 100% before these numbers.
You are the Kodiak in the bear cave. I don't think there's any question about that.
But I've been right. Everything I've said on this network for 2 years has come true.
Well,
and
you're terrifying me. Jim, what do you think? Are we headed for recession?
I don't think so, Melissa. I find the outlook to be a little more optimistic than that. You know, if that's right, one of the things that the market's saying, I mean, we look today and we're all scared about a collapse and all the bad news, and the stock market today in the United States is about 6% from an all-time high. Well, I mean, commodity prices, non-energy commodity prices are at new cycle highs. I think if it was really going to be that bad, the markets would be sniffing out worse momentum.
Think about it logically. How can we not have a recession? I mean, our economy is 72% consumer spending. What have consumers been spending? They've been spending their home equity. That's gone. They've been relying on temporarily low teaser rates to consume more than they can afford. Those are gone. But and commodity prices, food prices are soaring, energy prices. You know, there's no way we can avoid a recession. And we don't want. We only
have a few seconds, Michael. Last word to you.
We can't argue with a lot of Peter's data, and I don't. But look, millionaires have been through this before. You stick with your knitting. You look at your companies. You make sure they've got strong balance sheets. You make sure that they've got good long earnings histories, and they've got good strong organic earnings, and you have international exposure.
We've got to leave it there and stick with our knitting. Thanks to all three of you for joining us tonight. Want more Green Speak? September